so my volume is muted. So what do I do here now? So that's done, right? Let's see here. I just go back to my, oh no. I think we're good.
Yeah, I think so.
All right, very good. And then I'll have to unshare to let my host, or my guest speaker, share her screen.
Hi, Annabelle.
Hey, Sophia, how are you?
I'm good. How are you?
Oh, I'm doing great. Thanks so much for joining us.
Always a pleasure.
All right, today will be extra special.
I can't wait. I'm excited.
Yeah, it's gonna be good. All right.
How's everything going on?
Everything's going on good. Can't complain. Yeah, everything's good.
That's good.
How about you?
Yeah, everything is good.
All right.
Yeah.
Very good. Let's make sure that we'll give a couple more people minutes and then we'll get things going. Hey, Sophia, have you been able to connect with the agent?
You know what? I think you told me did you say you were going to send me her information, or you actually sent it?
Yeah, I did send it. You should have gotten it via email.
And what's her name one more time?
Oh gosh, let me see here.
Forgot.
Let me go
Okay.
to my thing because
Honestly, I don't think I
Sherry Spain.
It really does not ring a bell. Like, I don't
Okay.
think I saw anything from her.
I'll get you her info.
Where is
before-
she from?
She's
I
from
mean,
Atlanta.
No, I mean, which brokerage?
Oh, EXP. She's with EXP.
Oh, she's with EXP.
Yes.
Oh, okay.
So I'll make sure to get you her info for sure.
Yeah. I mean, I also, because I've been actively, looking to buy. So I did speak to a few people.
Okay.
I actually have an agent from my office here who also moved down there.
Got it.
So yeah, but definitely I have not, retained anyone yet. I have not really decided yet who I was going to go with, who was going to help me with that, because I'm still dealing with the bank. So yeah, I think
Okay.
by all means, send it to me, and
I sure will. I sure will. Hey, Jess, can you help me out? Our guest speaker says she can't get in with the, oh wait, no, she's in. She's in. Oh wait, let me make sure. Oh, I let her in. Let's make sure. There we go. Sandhya, are you in?
Hi, thank you. I'm sorry, I was trying to get in the last couple of minutes and there was a problem. Can you see me and hear me well?
I can see you and I can hear you well. Perfect. Thank you so much for joining us. So I'm going to go ahead and get started. And well, number one, thank you guys. Thank you everyone for joining my weekly call. Let me go back here for a second. So thank you for joining my weekly call. And really quick, I just wanted to let you guys know my name is Annabelle Pacheco. I am an investor and a real estate broker, been in business for 24 years. And really my goal for this call is to share with each one of you in detail the 8 steps that I took to purchase my first multifamily deal in hopes that you guys will also do the same thing. I want everyone to know on this call that I'm not selling anything and I'm not offering anything, and I am not a financial advisor. I am just sharing my story with you guys in hopes that you guys can use this platform as well to share information with each other. And you know what? Let's just learn from each other. It's critical. And just a little information about myself. I started in my career in the mortgage industry back in the mid 90s. I purchased over 100 properties throughout my career, and we did a lot of flips, rehabs. I leased properties out, managed properties for some time as well. In 2001, deviated a bit from real estate, built a 150 capacity restaurant from ground up, had a staff of about 15 people, including managers, chefs, and servers. And in the last 10 years, I focused 100% on my real estate business and representing both clients in residential and commercial real estate. Give me 1 second, just admitting a couple people here. In 2000, this is wrong, in 2015, I purchased my first multifamily deal, which was 34 doors in Texas. I'm in Grand Prairie, Texas. And really at that time, you know, my husband and I were looking for a way to create cash flow and just looking for generational wealth. And oops, good. Something happened here. Can you guys see me? Yes?
Yes. Yes.
Okay, sorry about that. Something happened there.
Yes, I can see you and I
Oh,
can hear you well too.
Okay, fantastic. So we were looking for, you know, how do we make our money work for us, right? And here are some of the reasons why I invested in multifamily property, and I hope it inspires you guys to do the same thing. Number one, we were really looking for cash flow, right? What's going to give us what can we do where we can just generate cash flow? And in just simple terms, cash flow is your rental income minus all of your expenses. We were looking for a way to have our loan be paid down, right, by our tenants. So multifamily was just that. We were looking also for appreciation, right? You bank on that the property eventually over a long period of time will appreciate. And also there were those tax benefits that we were looking for. And there's many other tax benefits, but the two for us were depreciation, right, which allows you to expense a portion of the physical structure each year, and then a 1031 exchange, which allows you to defer the capital gain taxes. No limit, right? You can defer this as many times as you find opportunities. So just in a really very short just example, the property that I found was a value add multifamily property. So we purchased this property for $850,000. We spoke to the seller at that time, and the seller was willing to carry a note for us for 2 years. So we gave him a $350,000 down payment, and the seller financed the additional $500,000 for us for those 2 years, which allowed us, number one, it saved us a lot of time and headache, of applying for the loan. And it allowed us also to remodel and update the units and increase the rents. And after that second year, we were actually able to refinance, and property appraised at almost double of what we had purchased it at that time. So it appraised at about $1.6 million. We refinanced, cashed out about, $1 million, got all of our money. So we've got zero money invested in this property, and today's value, it's valued at about $2.7 million. So you could say that, we hit a home run, and I'm sure many of you on this call will probably look at this and say, wow, that's impossible. You know what? They're out there. You just have to look for it. This was a 5-year plan for us. We were out looking, connecting, talking to different people, and you know what, when it's time, it's time. And when you're ready, when you are ready, that those opportunities arise and come up. And so this is just in a nutshell my story and what happened to us. And I think that moving forward, if I want to grow, it's obviously, there's an opportunity for me to sell this right now. I mean, I'd make a really good return on this property, sell it, and try to get myself into something else. But with prices being so high, I don't know. I'm still kind of on the fence about doing something like that. And the reason I thought it would be just wonderful to bring Sandhya, invite her, is that she does a lot of this stuff, and she's involved in syndications. And I thought it would be great for her to share with all of us on this call, what she does, how she's done it, and what we can all learn from this, and possibly maybe connect with her, to maybe do some deals, some additional deals. So Sandhya, welcome. Thank you so much. Let me stop sharing my screen so that you can share if you'd like to share, but welcome.
Sure. Thank you so much for having me here. I don't quite have the wide real estate experience that you do. I started out like most Indian geeks, so I'm going to share my slides with you. I started out like most of the Indian geeks you probably know, who probably were good in math and went to school. That's what I did. I went to engineering school and got a corporate job and was very happy working in the Dallas area for Texas Instruments. And so my background is engineering and business career. I worked for TI, and I realized that all the business folks were making all the decisions and telling us engineers what to do. So I switched from that. I got myself an MBA and learned finance, learned the stock market, etc. And so over 2 decades now that I've been on the stock market, and I ended up paying a lot in taxes. And that's why I wanted to go into real estate, to where I could get some of the benefits that you just talked about, except I had no prior experience. So single family was kind of scary because I'm not a handy person to go and fix toilets and things. So I had to go do something like multifamily, where I could afford the economies of scale and somebody could run the property for me. So currently I'm a GP in 476 doors. I have another one under contract now, which will be an additional 154 doors to that count. I'm also passively invested in over 4,000 doors. So this is slightly outdated. So the main thing I want to say is I want to explain what's an apartment syndication and what is passive investing. How does it compare between like the single family stock market versus multifamily, and discuss a little bit of investment goals and risk tolerance and how you can minimize your risk. And then how do you vet a deal sponsor before you decide to partner with them, either as a joint venture, a limited partner, or a syndicator? Right? What are some things you should ask before you partner with someone? And what are some metrics to look for when analyzing a deal? And if there's any other questions, we can certainly answer them. I mean, feel free to stop me whenever. So I'm not a financial advisor or CPA, not here to tell you what you should be doing. This is just my opinions from my experience. There is no solicitation of any kind here. I don't know all of you, so I cannot offer you any kind of an investment proposition with this conversation. And so this is strictly just for informational purposes. And you have to do your own due diligence of people, of deals, etc., before you decide to get into any kind of a partnership. My inspiration is that if you don't make money while you sleep, you will work until you die. That's Warren Buffett. So I kind of want to be able to sit on the beach or make money in my sleep, so to speak, without always having to trade my time for money. So what is a real estate syndication, right? This is where several investors pull their money together to buy a large property. So the apartment down the street from me might be $10 million. I don't have the cash to buy a $10 million apartment. So what do? I get a loan from Fannie or Freddie for a big portion of that down payment, right, of the mortgage. So $7 or $8 million. And then for the down payment, which could be $2 or $3 million, that's where I raise money from limited partners. right? So I have several investors who will each, contribute 50,000, 75,000, 100,000 into the deal. And together we make up that 2 or 3 million. And then we also get a little more money for rehab. So maybe I need to spend $500,000 in rehab on that property. So maybe that's $2.5 to $3 million that I have to raise. And that's my down payment. And I get the rest funded by Fannie or Freddie to buy the property. So this is where we distinguish between who's a general partner, who's a limited partner, and who's a key principal. So I can't hear you if you're trying to say anything. You have to unmute yourself, Annabelle. So limited partners are passive investors who put in the money, but they do not make any of the decisions. A general partner or operator is the person who runs the investment, and they make all the decisions to execute the business plan. And a key principal is someone who signs that loan. They have the liquidity and net worth, but they are still more like a limited partner in the sense that they don't make decisions on what to do and what not to do with the property. So they're not really the operator. And unless something bad happens with the general partners, the key principal usually doesn't step up to run the property. So those are the three different terms we use interchangeably: LP, limited partner; GP, general partner or operator or owner, a deal sponsor; and then KP is a key principal. So what is passive investing? Well, you're the limited partner. You're contributing money into the deal. You carefully analyze the deal and also the sponsor before you contribute any money. The money is working for you rather than you working for money, in the sense, once you do all your careful vetting, it's sort of like you're a passenger on this flight. You make sure the plane, and you vet the airline, you make sure it's a major airline without a lot of crashes. You make sure, you buy a ticket to the destination you want to go, and then you pick your seat. And once you're seated, you're all set. That's a passive investor. You're not the pilot. You don't determine which aircraft is being used, etc. You just go on your flight, enjoy the ride, and hope at the end you get what was initially projected, which is, a timely arrival with all your bags intact, etc. Right? So same concept. That's a passive investor, as a passenger on a flight. Money is working for you in the sense that once you're on this flight, you're not really working on anything related to how the aircraft gets to its destination, right? So you're not working on this property to make it make more money, worrying about the rent collections and all the other issues like snowmageddon happening and having to rehab the units, etc. None of that is your problem. You're a passive investor. You wait for your mailbox money. You don't also carry any of the liability. So if a tenant sues the owner for negligence for any reason, that's not your problem as a limited partner or passive investor. These are some of the reasons I like being a passive investor also, in addition to being a general partner, because I don't have the headaches and worries of running a property. The other part I like about it is that I've already done it. Most of us have already done it in the stock market. We don't get to say what, the CEOs of all these companies do. We just put money in that stock and we hope that it grows, or the mutual fund, right? So we're already passive investors and familiar with it from a stock market perspective. This is just an alternate investment that might give you other benefits as well, like tax benefits. So let's say you invest $100,000 into a deal, and they have what is called depreciation, which is one of the benefits we'll talk about. You get to offset some of the gains from this investment with that depreciation paper loss. So let's say the passive investment earns you $10,000 this year, but then the depreciation is more like $60,000. Well, then you don't really pay taxes on that $10,000 right now, because your paper loss is greater amount. So that kind of cancels it out, and you still have some loss left that you could use in the future years. You can't do that when it's a stock market gain, right? If you gain $10,000 in the stock market, you're going to pay capital gains at whatever the tax rate, depending on whether it was a short-term or a long-term hold. So there are many advantages to being a passive investor. And the biggest one is, I think, not taking on all the risk yourself, but still being able to enjoy the benefits of being invested in real estate. So if you've ever done single family, and we'll talk about that a little more in our comparison, you should definitely look into passive investing in multifamily. So the comparison I make is that in single family, right, you have a neighborhood and you have many houses in this neighborhood. The price per square foot is kind of set for that neighborhood. Like, I'm familiar with the Dallas area, so I'm going to give some Dallas examples. There's a fancy neighborhood called Highland Park, or if you're in California, you probably know Beverly Hills, right? And so on. So certain neighborhoods have a definite price per square foot. You can't change that just because, you have a gold-plated whatever fixtures inside your house. But in multifamily, you could have two apartments side by side next door to each other, and they could be completely different value, even if they were built the same year and have very similar amenities, because we do what is called a forced appreciation. Because the value of an apartment is like an individual business. It's like you have a dry cleaner next to, I don't know, a restaurant. One is completely independent of the other, right? So it's how you operate the apartment. The net operating income of the apartment is what determines its value. NOI, or net operating income, divided by the cap rate determines the value of an apartment. So we do what is called forced appreciation by increasing the NOI. We do that by increasing the revenue of the apartment, which is your other income, your rent, et cetera, collections, and you reduce your expenses so that your operating expenses, when they are reduced, the difference between your revenue minus operating expenses is your net operating income. And when the NOI goes up, the property value goes up. So as a more efficient operator, you can improve that NOI and force appreciate the value of the asset. So that's what is cool about apartments versus single family. The other thing is the economies of scale. So you have 100 doors and 2 tenants don't pay. It's not as big a deal as you own 2 single family and one of them doesn't pay, right? That's a very big impact to your bottom line. I also looked at apartments versus homes in terms of rental value. And at least in the Dallas area, the margins I would make is maybe $300-400 per single family rental. And for that, I have to sign a bank loan, which is a recourse loan, right? So I have to sign a bank loan for $200,000-300,000. And that works against my abilities to borrow again. That limits my borrowing ability for additional properties, versus, multifamily, I'm in debt for, I think, $30 or $40 million, right? And my net worth is nowhere close to any of those numbers, but I can still keep borrowing. Like I borrowed, $9 million on a property in December. I'm going to borrow another $15 million on another property. So non-recourse debt is great as an operator in the sense that debt from one deal doesn't affect your ability to borrow on another deal. So these are some of the biggest differences I noticed between apartment versus single family. Economies of scale, recourse debt, not being able to force appreciate, your value being based on net operating income, and the margins just don't do it. And my lovely pictures in the bottom are basically to tell you I'm not worrying about the tenants, toilets, and trash. That's the 3 T's I've got there. And I actually have a 4th T. It's also termites. Lovely, beautiful things called termites. I don't worry about any of those things when I'm dealing with large scale apartments because a property management company operates it for me on a day-to-day basis. I have leasing manager, I have maintenance staff, et cetera, who take care of all of that. And so as an asset manager, all I do is make sure the financials are okay and it runs really well. If you have the right property management company with experience, local experience to really know what makes sense in that market. The other thing is, your stock market, the big benefit is it is actually a liquid asset, right? So if you wanted to go in and cash out from a stock because you needed cash urgently in 3 months, you could do that with the stock market. Real estate, any kind of real estate is less liquid. I think we're all familiar with that. Now, one of the things I don't like about the stock market is the very high volatility, right? Depending on the whims of the Wall Street, your stock market portfolio can go up and down. I remember in March of 2020, when COVID hit, there was that one day when everything crashed. And I saw my stock portfolio really plummet a huge amount versus my multifamily portfolio was pretty steady. Rent didn't change in one day. And even the end of the month and the next month, when we thought, oh, no one can afford anything, I'm going to just lose all my money, it didn't happen. I had maybe a very, instead of having 95%, maybe I had 94% of my tenants pay in full. So it was not really a huge difference. And then the ones who couldn't pay, we were able to work out payment plans. They showed evidence of losing their jobs. They were able to get stimulus checks. And most of them, paid their rent or made attempts to pay their rent. So I didn't see the volatility in real estate like I saw in the stock market. And if you look at any statistics from the National Multifamily Housing Council, et cetera, data from 2019 versus 2020 versus now 2021 rent collections, there's not a huge fluctuation just because we were in a pandemic for over a year. And feel free to interrupt me anytime if you have any questions. In terms of multifamily, why I got into it is that every rich person I know had something to do with real estate as one of their investments. You know, you think of the richest actors and, you know, athletes and everyone else. Somehow they start putting their money into real estate and then it just grows like crazy. That's how they build wealth. And then it is also a lot more recession resistant, right? You look at how many industries kind of collapsed, the retail industry, restaurants, travel, all of them took quite a beating last year with COVID. We all went through that, but good old apartments, everybody needs a place to live. If in fact, people spend more time at home and use the amenities in their apartments even more. The other good thing about multifamily investing is you get the cash flow because every month rent is collected on the first of the month. And we do forced appreciation. And if you're careful in vetting the people and the market where you invest, it actually produces, in a lot of cases, much better risk-adjusted returns than the stock market. At least that's been my experience. Now, if you are one of those smart people who bought Tesla, held on to it, sold it when it went public, et cetera, I mean, that's great returns, right? So I don't know that I can compete with that, but in a lot of ways, multifamily, I felt, has done less risky, risk-adjusted returns than the stock market. When you invest in an apartment complex and you're a limited partner, you get reports, monthly reports on the financials and how the property is doing every month. And that's a good way for you to discuss and ask questions if you want to learn more. Like I was a passive investor first before I started owning my own properties, because then I could ask questions. I tried to invest in properties that were local to where I lived in the Dallas area. So I could drive by these properties. And when I get a monthly report and they say they're fixing something, I'd be like, hey, are you going to be at the property? Can I come and see what you're doing so I can learn? Because I didn't come with a real estate background. So I wanted to learn. So I learned first as a passive investor for a few, for a few months. And then I went in as an active investor. So that's one of the things I like about apartment investing. The other thing to keep in mind is what are your goals and what is your risk tolerance, right? So 5 years from now, what are your financial goals? How much of a cash flow do you want to get? Like I'm starting today with, $100,000 and I want to make it into this much money in 5 years. It's a financial goal and you can decide, am I going to get there with single family, multifamily, stocks? What's going to get me there? And even within multifamily, for example, at what role do I have to play? Do I have to be a limited partner or a general partner or a joint venture to get there, to get the returns I need? And don't forget tax benefits from depreciation. I think every person's situation is different, but in some cases, right, you can get a lot of depreciation if you're a qualified real estate professional. So you definitely want to look into that with your accountant. And the other thing is the whole risk tolerance, right? I always recommend having some level of cash, but the way it's going right now with the economy, I think if you just leave it in the bank, you're going to be losing money. Literally, your money is going to be worth a lot less in 6 months if you just leave it as cash. So if you've got cash sitting around in IRAs, retirement funds, et cetera, from previous employers, definitely put it into some kind of investment, whether that's apartments or something else. That would be my best free advice. And again, I'm not a qualified financial professional to tell you what to do.
So I have a quick question.
Yeah.
So what does a dollar amount determine what, if you come in as a passive or as a limited or as a general, or do you select what you want to be based on the amount of money you invest?
I think that the general partner generally makes more money,
Okay.
right? Because they do the work. So they generally take a paycheck, so to speak, for themselves. But as a limited partner, like in a typical investment, you should be able to double your money within 5 years. That's pretty reasonable. In some cases, it can happen sooner. Like I bought a property in August of 2019. It was 86 doors in the Dallas area. And we had projected 5 years of about 70 to 80% return to investors. And the market has done so well, and that property has done so well that right now you can double your money. So we are actually listing it for sale. So that's less than 2 years. We're going to double our investors' money. And so that's not typical, but that's done extremely well.
Okay.
So you just never know. But I think as a limited partner, plan to double your money in 5 years. And I think that's reasonable. And that includes all of the cash flow as well as the appreciation. Now, as a sponsor or owner, you are taking on a lot of risk. You're putting hard money down, etc. But depending on the deal structure, you could make a little more. You could make, 3 to 4 times more or even more. 5, 6 times more, right? Depends on how you structure the deal, how well the deal does, right? The performance, etc. And all the headaches. I mean, if you had Snowmageddon and you got 20 units down, cash flow is going to be limited for a while. And you don't take distributions as an operator or sponsor unless you can also make distributions to your investors. So, the cash fluctuates just like any entrepreneur, any business. It's not a steady paycheck like a corporate job, right? It goes up and down. And so that's one of the risks you're taking on as a sponsor, but that's also why you get rewarded.
Okay. So if someone wants to go in a syndication, what's the minimum amount dollars that they would need to go in?
I think it depends on every deal. I've had smaller deals where they take 25,000 or even less. But the average deal that's in the 10, 15, $20 million range, they'd like to take 50K as a minimum. But here's the way you can work around it. Let's say it's you and your brother or a couple of friends and you want to go in together. The 3 of you can form an LLC. And within that LLC, you can contribute different amounts depending on how much each of you want to. The LLC can come in with that 50,000 and invest into a deal. So if you want to start small and minimize your risk, 3 of you can pool your money into one LLC, and then you'll have to distribute because all the tax statements, K-1s, distributions will come into that LLC, and it's up to the 3 of you to figure out how the splits work between the 3 of you, depending on how you contributed.
And then, I also hear a lot about like accredited investors where there's like a minimum of 250,000 that they must earn, and you have to show like documentation of that. What's the difference between that?
So I can talk about that. There are 2 different types of investment opportunities that come from multifamily, and that's based on the SEC guidelines. There's a 506B like Bravo, which is the kind of investments I do. So even though I currently have an investment, I can't offer it to any of the audience here except Annabelle because I don't know anyone else. So 506B is where you should have had multiple rounds of conversations. You should have a pre-existing relationship with this person before you can offer an investment to them. So you can't advertise it. I can't put out on Facebook, hey, I have a deal, who wants to invest? You can't do any advertising of that matter. And I can only present it to people who are in my investor database because I know them and they have a prior exam. Whereas a 506C like Charlie, that is open only to accredited investors. Whereas my 506B that I do is open to sophisticated non-accredited investors, meaning they have the sophistication to understand the risk involved in investments of this type, but they may not have a net worth of $1 million. So there's 2 ways you can qualify to be an accredited investor. The first one is your net worth must be $1 million outside of your primary residence, or you must have earned as an individual at least $200,000 the last 2 years and expect to earn that again this coming year. Or if you're a couple, then it's $300,000. But that's a definition for accredited investor. And so if you invest in a 506C like Charlie investment opportunity, you have to fill out the paperwork to show that you by yourself as an individual are accredited. Versus in a 506B like Bravo, 3 of you could invest and none of you have to be accredited. You could all be sophisticated because a 506B can take up to 35 non-accredited investors.
Got it.
So that's the biggest difference between the 2. 506C like Charlie tend to be larger deals with larger investment amounts. And that's why they advertise it everywhere, because they need to have that, widespread publicity. The other thing is they don't have the requirement to establish a connection. So if I today, for example, had a 506C like Charlie investment to offer you, I could advertise it right now. I could make a whole investor pitch to all of you in the audience without having to know any of you. And I can advertise it, and that is considered, I'm within legal bounds to do that. So that is the advantage of a 506c like Charlie. However, it's like, I think at least 85 to 90% of all the money raised in the past 12 months on these types of deals has all been through 506b like Bravo deals. I think C like Charlie is getting more popularity now because people can advertise and they're trying to do larger and larger deals. But I prefer the B because I feel like you have to get to know someone pretty well before you invest such large amounts of money. I mean, if you think about how much homework you did the last time before you bought an appliance for your house. I mean, you looked at this and this. I mean, I remember how much time I spent the last time before I bought a refrigerator or washing machine or something, right? Look at this investment amount. It's a huge amount. So you've got to really do your vetting pretty carefully. So one of the things I always say is you have to know you're betting on the jockey as much as the horse, right? When it comes to multifamily. So how much do you really know about this person with whom you're considering an investment? The number one success factor is the sponsorship team. So no matter how great a location is and how wonderful the property is, if you don't know the team, hey, you never know how they could do. So I would say that it's a pretty big risk to invest with someone you have just met. You have to know, like, and trust them before you invest your money. And what is their track record? Because if you just ask them, they're only going to tell you the good parts of it, right? It's like, what do you know about somebody from watching their Facebook? Only the good stuff. You know, they post a perfect picture of this family on a beach or something, and then next month you hear they're breaking up, you know? So you have to really dig deep, right? Ask them for their track record. Give me a list of all the properties you own. Okay, great. Now tell me somebody who's invested passively in every one of these deals. So ask for references and then ask them who's local to the market. Here you are, and there's nothing wrong with sitting in California or New York and investing in a property in Atlanta or Dallas, but do you have a partner who's local to that property, who's boots on the ground? And do you have someone experienced in managing it? So your PM, property management company, has to have experience in that market. The other thing I recommend is doing a background check. A background check is not super expensive. If you're going to invest $50,000 with somebody, spend the $50 to investigate, right? Look at their history of bankruptcies. How recent was it? If it was in the 2008 crash, okay, that's fine. But if in the last 5 years, because of multifamily or real estate, they've gone bankrupt once, it's like, I don't know if their financial, savvy is the best to be able to run a property like this, right? So it's always good to know that. I mean, criminal background, et cetera. If they're going to be in trouble with the law for things, I mean, are they going to have time to run your property and make money for you? Right. So the other question.
Jesse has a question. Go ahead.
Yeah,
Jesse.
hi. Thank you. It's very, very informative. What we're talking about today. I have a question. Let's say a simple deal, the $10 million deal. You're looking for $3 million. The person that finds the property, okay.
Uh-huh.
What amount of the $3 million are you usually try to raise, and what percentage does the person that found the property keeps on? How does that work?
So my properties have all been listed by major brokerage firms in Dallas. Dallas is a very hot market for multifamily. So I don't tend to do off-market deals and wholesalers and things like that. They usually get the deals that nobody wants. So let's say I have a property, right? I have a really good property that I acquired in 2019. I'm getting ready to sell it with my partners. We want to list it in the market because we believe that the way that a broker is going to package and market our property get multiple bids, that's what's going to get us the most money. So the person who found the deal, what percentage do they get was your question. And I'm trying to explain how if the deal is listed in the market, everybody can find it.
No, that was not my question.
Okay.
That was not my question.
Okay, please clarify your question.
Yeah, my question is, when let's say you find a property that you're trying to buy, and you're gonna create a group, you're gonna offer it to to raise the $3 million. You, as a person that found the property, what percentage do you keep, and what percentage do you try to get? Out of the $3 million, how much money are you trying to raise out of $3 million for the down payment and closing costs and all that?
I'm trying to raise all the $3 million. I'm going to put down maybe 50 or 100 of my own money if I have it. But I'm
Okay,
going to raise.
so you as the person that found the property, what percentage of the property do you keep, or how does it work? That the syndication, the people that are passive investors, what percentage of the property they own? Let's say you find two investors that each have $1.5 million. What percentage do they own of that property?
Well, I usually have 50 investors. And so their split is based on what percentage of the property they own. So if my raise was $3 million and somebody contributed 50,000, it's whatever is 50,000 divided by 3 million. If I only had two people, right? Let's say I have to raise $3 million and there's, two people with $1.5 million each, we'll just do it as a joint venture. That's not really as much of a syndication. Because if I have large investors coming in at that level, that would be a joint venture. So I'm thinking more of, 20 investors at 50K each amounts to $1 million. So at 3 million, it's probably 50 to 60 investors. So they all produce, 50K, 75K, 100K kind of investments. It all adds up to the total of 3 million. Now, in terms of the split as far as between the general partner and the limited partner, so everybody's contributing around 50K, and the main operator, me and maybe two of my partners, we're the main operators running the property. The limited partner versus general partner, that split is usually 80-20. So let's say the property is bought for 10 million, is sold a few years later for 15 million. We pay all the loans, we've done some cash flow, etc. Whatever is remaining, let's say for argument's sake that we have $5 million left at the end that is to be shared among everybody. Then 80% of that, which is 4 million, goes to all the limited partners, depending on how much percentage their split is, right? Their ownership of the property. Then the remaining 20% goes to the general partners. So if there are 3 or 4 general partners, they each get a piece of that, depending on how they worked out their management agreement. So like in my very first deal, when I was a newbie, the experienced guys took the bulk of the share, right? I got a tiny sliver. But as I get more experience, I might get an equal share. So how the main general partners split their profits is a management agreement that they work out separately. What as a limited partner or someone looking at this deal is what slice the general partners get versus limited partners, that overall percentage. So 80-20, for example, is the split I typically do in my deals.
Okay, yeah, that's the answer I was looking for. Thank you so much.
Perfect. So limited partner versus general partner split varies from deal to deal. There are also a lot of larger deals, 506C types of deals typically do this, to where once they reach a certain return, right, a hurdle, like let's say they double your money. Well, after that, they might say, well, I gave you an IRR of, 17%. Now I'm going to reduce how much you get. Now I'm going to take it from a 70-30 to a 50-50 split. A lot of them do that. So every deal is structured differently. So you must closely read your subscription documents and see how they split the fees on every deal. It varies depending on the sponsorship team, what kind of fee structure they take. There are so many different fees. So I'll talk about that too. So one of the things I look for is skin in the game. So a lot of sponsorship teams take a lot of acquisition fees up front, right? So they take a 1% acquisition fee on a $3 million deal. Okay, that's reasonable. They take a 3-4% acquisition fee on a $50 million deal. Oh my goodness, that's $2 million, right? So if they take that much money up front, because acquisition fees is paid at the time of closing, then what skin in the game do they have? How much money do they still have left in the deal? In other words, if the deal goes badly, does the sponsor have anything to lose financially? So that's a question I ask. So this is my skin in the game question. Another question I ask is what kind of communication frequency, how transparent they are when things go bad, how often do they respond to you when you ask questions? What contingency plan do they have to protect the investors? What if the main lead sponsor, who's doing a great job running the property, gets hit by a bus, then what happens, right? All of those things you want to think about and ask questions about before you invest. So another thing is full cycle. That's one of the points I have on the slide, if you can see it. And I really think it's important to know what is the roles and responsibilities of each team member. So you know who to ask questions when there is anything that's happening on the asset management side. Because a lot of times teams have people who only raise capital. Those are the marketing kinds of people. You see them on all the podcasts and you see them everywhere, but they don't know anything about running the property. So once the deal closes and you have a question as a limited partner, you're like, who do I ask? And this person, they've sailed on to their next conquest, you know, the next capital raising deal. So they're done. Once the deal closes, they get a little fee and they're done. So that's something else to keep in mind. So another thing I look at is the deal itself. What kind of metrics do I look for, right? What is most important to me? Do I want a preferred return? Is the cash flow important to me? Do I not care about the cash flow? Like I invested in a lot of deals with my retirement money from my previous employer. So I didn't care about the cash flow as much as I did about the growth itself. Like I wanted the capital to be safe, but I also wanted the maximum growth in 5 years. If I could double or do better, that's more important than getting $100, $300 here and there, because it's retirement money. I don't need it for another 10 years, kind of long-term scenario. So depending on your goals, again, you should look at, does this deal do that for me? Because if it's a very distressed deal, they're going to take the occupancy down, they're going to completely rehab the units. You may not get cash flow for a while, and you have to see if that's okay. That's a risk you want to take. Versus some deal that's already doing really well and cash flowing, stabilized, 95% plus occupancy, they're just going to do some light rehab and increase the value. And the sponsor split is what I was talking about earlier. Is it 80-20, 70-30, or 50-50? And then you always want to analyze the market itself, right? You want to use what we call the tailwind in a flight rather than headwind. And so the tailwinds right now from a market standpoint are all your Sunbelt states. So your Phoenix, your Atlanta, Dallas, all of those, and parts of Florida, excellent places to invest in multifamily, the Carolinas, Tennessee, Memphis, some places like that. Versus you definitely don't want to be spending time in the New Yorks and Californias for real estate that tend to be much more tenant friendly than landlord friendly to do business. So you can't evict anyone, even if they collect stimulus checks and they don't want to pay. There's people who are getting paychecks who can afford to pay their rent and refusing to pay it, thinking we never have to pay, come after me, try to collect from me kind of thing. It's like you have to fill out CDC paperwork. You have to show me evidence you lost your job because of COVID, or somehow you were impacted, and then you have to come to me, make payment plans, or apply for rental assistance. It's not just sit at home all day, watch Netflix, and get money. That's not how it works. So we can explain that very well in Texas. It's hard to do that sometimes when you're in the West Coast or the East Coast. So what other questions can I answer for you about apartment investing? That's the bulk of it in a nutshell.
Perfect. No, I think it's great. What was that? Someone asked, or someone made a comment here.
I have another question.
Sure.
Can you refinance, let's say 4 years from now? I mean, you obviously have to have an agreement with all the passive investors and everybody, but can you cash the passive investors out in 5 years or 6 years or whatever the term is?
Every deal is different. Every sponsorship team is different. But the biggest thing about refi is the terms of your loan. If you have a yield maintenance Fannie Mae loan with a high penalty, I don't know that you can refi, right? You may have to sell it as an assumption. And the interest rates are pretty good right now, so it may not be a bad idea to do that, right? So, but then if you have a bridge debt, or if you have a floater, something with a good exit plan, or a step down prepayment penalty in your loan, then you might be able to do that. So the decision is made by operators. They can inform the passive investors or the limited partners, but they don't need anyone's vote or permission to make those kind of decisions. It's completely under the control of the sponsors or operators.
And
okay.
how do you become a general partner?
Well, it depends on what you have to offer. In my case, I joined a network of people, apartment investors. And, you know, you go to your mixer, you go to conferences, you exchange business cards, you find people you like. So when you become a general partner, business partner with someone else, I call it a business marriage. So you want to date first and get to know them really well, because this is someone you'll be dealing with very closely for a while. So once you identify people you like and trust, some of the things you look for is people with complementary skills to you. So if you like to do underwriting and you're really strong in math, but you don't really want to go raise capital, you want to find someone who wants to go raise capital, right? And if you don't like to go into the details and you're sitting in California, you don't want to manage a property in Texas, but you want someone local, boots on the ground, then that's a person you partner with, right? So you find out what you like to do and what you want to do, and then you partner with people who want to do the things that you don't want to do and who are skilled at those things. So complementary skills. And then, okay, are you wanting to be a deal finder? Or do you just want to raise capital for anyone who finds deals? So accordingly, that's your strength. And that's how you find your first deal. So my first deal, I went after the deal. It's in Dallas. It was listed by brokers. My partners, who I eventually ended up partnering with in this deal, we were part of the same group. We had met before and talked before. They also went after the same deal, but they were both out of state. So I told them, listen, I can look after all the day-to-day stuff for you. You can make the decisions because you have more experience than me, but I can be the hands-on worker bee while you direct me. And this way I learn in the process too. And so that's how I got my first deal. It was listed in the market by a broker. So anybody could have, looked at that deal and underwritten it and, gone after it. But I didn't have the confidence to do it on my own as a first timer. I didn't want to make mistakes when it involves other people's money. So I wanted to minimize the risk.
Yeah. And I think that's where like my strength is, because I've been in real estate for over 20 years.
Mm-hmm.
I have clients that trust and like me,
Mm-hmm.
that have the money and, would invest, but there's
Mm-hmm.
that fear of me taking money, right? Like I don't mind investing my money. If I
Right.
lose, it's just me. Putting, getting other people's money kind of put a little bit more of pressure, right? And but I know that I have many clients that would invest, and they know my story. They've because when I purchased my first multifamily, which was about 6 years ago, I would share it with my clients. I was so excited, thinking, hey, maybe this is a good opportunity. I'll get more people to invest in maybe some additional property, right? Like more property. But again, I was going through this myself, and it worked out great. And so they always ask, hey, how's that property doing for you? And I'm like, my gosh, it's doing amazing. It's great. So they're like, okay, well, we've got money. We want to invest. We definitely want to, but it's a different market. Today, at least for me, and I don't know, you're out there looking at properties have, mine has quadrupled in value.
That's really an excellent track record that could encourage investors to invest with you. So if I was in your position, I would start networking with people in the markets where you want to find your apartment. Like, do you have something in Grand Prairie? Was that it?
Yeah, I have the 34 units in Grand Prairie.
So you can find additional operators in the local area, and you can even talk to them and see, do they really know what they're doing? Because now you've run a property there, you know what you're doing. So you could easily vet somebody out in terms of what they know. So also decide, what do you want them to do and what do you want to do, right? And then make a short list. Okay, I'm going to get to know these 10 people, or these 5 people, or these 3 people, right? Who are showing promise, whose personalities I like, but who also seem to be the kind of people who'll do the work for me and I can direct from here. Because my partners are out of state, as an example. They still do a lot of the directing, especially at the beginning. I had no confidence. So whenever they would say something, I'd be like, okay, let's do it. Then a few months into it, I was like, oh, but can we try this instead, or something like that? And so you slowly learn and you get your knowledge. So accordingly, identify what you want to find in a partner. If you want to trust somebody else, or if you just want to run all of it yourself, you definitely need somebody who's not living with you, not your spouse alone or somebody else, in case something happens, right? You always want to have at least one backup person as part of your, what I call, fiduciary duty to your passive investors. Like, I have to have at least one other partner in my deals. I ideally like to have 2. Somebody who can take over everything if, I get hit by a bus or I have to go on vacation, kind of scenario. Right. So once you identify the kind of skill set you want this partner to have, Then you start doing your getting to know stuff, right? You identify 3, 4 people, you do what you have to do to get to know them over a period of time and feel comfortable. And then again, it depends on your confidence level and how you want to approach it. But one approach I had was I took a small amount of my retirement money, smaller than the minimum they wanted in a deal, and I invested it with about 3 different people. And I tried to learn how they operate, whether I felt comfortable with how they operate, etc., to see if they would make good partners in the future. And this way, I'm not risking a huge amount of my money, and I'm not risking other people's money trusting these operators.
Right.
So that's another way to do it.
Yeah, that makes sense.
Because you learn how they operate, you get monthly reports, you see the financials, so you know, are they in charge? Are they doing what? Do they know what they're doing?
Right.
And it's just somebody I feel comfortable, because it is a big deal when you raise $2-3 million kind of money from other people and you go and trust it. So for me, I'm a control freak. I have to be part of the asset management general sponsorship side if I'm asking other people to invest, if I'm the one raising money. If I'm just being a limited partner, then I don't care. But if I'm raising money for a deal, I have to have a say in how the deal is operated. So you'll kind of figure out what your comfort zone is. And like I'd say, don't deviate from that. Right. If you don't like a certain market, don't invest in it. Like right. I don't like Houston. A lot of people love Houston. I just don't like Houston. I'm in Texas, I'm in Dallas, but I'm not going to invest in Houston. Right. And I prefer to invest in my backyard rather than something far away. I'm sure the Carolinas are a great market, but I don't want to go invest in the Carolinas. That's just my personal, I don't know anything about that market to know whether you picked a good neighborhood or a bad neighborhood.
Well, I mean, I'd love to in my own backyard, but it doesn't make financial sense.
Right.
California
you've invested in Grand Prairie, so it kind of makes sense for you to build a portfolio in that area, I would think, because then you have more of your economies of scale.
Exactly. Awesome. Anybody else have any questions? Let's take advantage. We've got a couple more minutes here, and we've got a syndicating expert on the call. So any questions?
I don't know about expert. But I'm going to put my email address here, and then y'all can decide if you want to email me any. Okay, I'm trying to type here this thing. Okay, I'm going to stop sharing. That's one thing I can easily do. And then I'm going to put my email address, and you can reach out to me if there's any way I can, help you.
Please do. Please put your contact info there. And
yeah,
I think someone was going to ask a question.
Sure.
Actually, I was. There was two questions. One is that you were talking about accredited investors and your assets. And say, for instance, you don't have experience, but you're capable of raising $1 million. So I have an LLC, and I have investors that will loan me money because they don't want to do real estate, but yet will allow me to basically raise the money. Is that frowned upon in terms of syndications?
No.
With lack of experience,
money,
but have the money?
You can raise all the money you want and bring it into an LLC, and then your LLC, which has $1 million, can come in and invest into a deal. You just have to work it out with whoever is the main person that you're wanting to co-GP with, right?
Okay. The other part
every deal is different. Every deal welcomes different investors. If you're coming in with $1 million, we'll have to talk to the syndication attorney, because that's a huge amount of money as to what role you'll have to play, whether you have to sign the loan, those kind of things.
Okay. Second question is why you prefer Dallas and Houston, and why not Houston? Because it's not in your backyard, or because what's the value in Dallas versus Houston?
Two good points. Yes, it's not in my backyard. It's a 5-hour drive. I'm going to have less control. I have to plan the visits there. Probably have to stay overnight because it's a 5-hour drive each way for me. So it's an inconvenience factor. But the second part of it is, there's floodplains and all of that. In Houston, you could have a really good property in a really good neighborhood, but 1 block away could be a really bad area. So it's very, very block centric. At least in Dallas, I feel like within a certain boundary, you could have about 2-3 miles of really good areas. In Houston, if you don't know it, you could go from a really good one to a really bad one in a very short distance, like literally a little hop, skip, and jump kind of distance. You could just go from a good area to a bad area. I just don't know the market as well. So why should I bother to take a risk on a market that I don't fully understand? And I don't like floodplains. People keep saying this is not in the floodplain, this is by the Galleria, blah, blah, blah. I'm like, okay, for the same amount of money, I would much rather have a property in Dallas than Houston. I've lived here 30 years in Dallas. So of course I know my neighborhoods. I know what was empty fields is now, like Frisco didn't exist back then other than, just, having a city with that name. And now it's got, I don't know, a bazillion people. So I just know my market so well. It's like, why should I go somewhere else?
Okay, thank you.
All right. All right. Any other questions? Awesome. Did you put your info, Sandhya?
Yeah, I put my email address and you have it as well. So if anyone needs to get a hold of me and doesn't have it, you can reach me through Annabelle as well.
Perfect. Awesome.
And connect with me on LinkedIn. That's an easy way to find me.
Perfect. Sandhya, thank you so very much. This has been super informative. Yes, round of applause.
Awesome. Thank you. Glad I could help. And,
love it. We'll definitely continue to connect. And obviously, I want to continue to grow my multifamily knowledge. So I know that I've connected with you and you've been great since the beginning. I mean, I have to say to everyone, I think how I met Sandhya, just really, really quick. A couple of years ago, I had posted something in the multifamily, I don't know if you remember, multifamily Facebook group. And hey, I'm in Texas, I'm in Dallas, I'm looking to meet up with multifamily. And she was the first person to respond and the first person that I met. We met for coffee. So it was really great and very knowledgeable. So if anyone's interested in any kind of syndication, she's definitely someone to connect with. But anyway, thank you guys again. We meet every Wednesday at 2 p.m. Pacific time. I believe it's 4 p.m. Central time. I'm here. If you guys have any questions or you guys want to connect with me as well for any additional information, you guys can just email me directly. And that's it. I'll see you guys next week. Thank you guys very much.
Thank you. Have a good one.
Thank you.
All right. Thank you. Take care. Have a great day.
Thank you.
Thank you.
Bye-bye.